Welcome to the Investment Process Channel. MC3 Christopher Campbell. This is the channel where we teach how to create generational wealth through trading. Let's get into it. Today we're going to talk about candlesticks. So I developed a little cheat sheet. They're pretty much basic candles. Everybody sees them. The whole purpose of this is to be able to identify them, to understand what these candles mean and how they affect the being able to predict the movement or understanding the movement of the market in the time and place that you're looking at it. One of the things we're going to talk about is bullish and bearish patterns. It's again, it's just the basics of the market. If you're familiar with them, then you can skip ahead. But pretty much, we're just going to be looking at bullish and bearish patterns of candlesticks and being able to understand what that means in a particular time frame in the market and also in the instrument that you're trading in. Candlesticks, they represent price, right? So in a specific time and frame. So the higher the time frame, the more effect it has on the momentum of the market at the time. So if you're looking at a monthly compared to a weekly, compared to a daily, and then you get all the way down, to a minute. Whereas if I'm looking at a daily chart or a weekly chart, it's pretty much, set in stone that that's the way the market is moving. If you look at a minute and you see the market is moving, there's so much fluctuation in the market at a minute, you can't really get a good picture of what the momentum of the market is at that point in time. So the higher the time frame, the more, um, how you want to say, the more support you have that the market is moving in that direction. So if you'll see if you get like three bullish candles, like let's say on a weekly chart, typically the market is moving bullish at that point. If you get three bearish candles, then on a weekly chart, then it's typically bearish. Now within those candles, there are fluctuations. You have your dailies, then you have your 4 hour, and then again your minutes. So you get a lot of ups and downs throughout that, but being able to identify those candles and understand how the market is moving and whether the buyers or the sellers are in control at that point in time is very vital. So here you see candlestick cheat sheet, how to spot candlesticks formations in any market and how to read them to act, right? So let's get it. Take a look at this. Candlestick types. These are our basic candlestick types, right? We have our bullish candlestick on the left. Um, and you see the body is where price has opened, is where it started at for that particular time frame. Let's just stick with hourly time frames right now. So at the beginning of the hour, price opened at that time. It may have price may have gone down to where you see the low part of the wick down here, and it moved all the way back up to a high point. But within that hour, when the hour closed, it closed at this particular price. So that is where the body comes from for when it opens and when it closes at the end of the hour. So we're just gonna stick on the hourly time frame right now. If you go down to a minute or whatever, it's the beginning of the minute, the end of the minute, right? Same thing. You know, hour, 4 hour, weekly, the beginning of the week, the end of the week. That's where price closed at. That's what the body is made up of. So, and again, we'll look at a bunch of different variations of it. Um, some you have candles with no wicks. Some you have candles with long wicks on one side as the high side, and the low side is really short. All those different types of candle types, that will dictate something else in understanding the market and where it's going. So, and vice versa on the on the decreasing or the bearish candle, it's just the complete opposite. So the opening price is on top, as you see from the green arrow. Um, that's when price started, and then when it closed at the end of the hour, it closed at the bottom. So for the bullish, it starts on the bottom and moves up. Price moving up is bullish, and for a bearish candle, price starts up and moves down, right? So therein lies the difference between a bullish candle and a bearish candle. And again, the same thing. Um, for a bearish candle, where it opens at is high and then it moved down, and at some point price probably moved up a little bit, and then it provided a wick, and then it went down. It went down to its low point and then closed at the end of that hour, and then you have your body. So again, pretty much simple on candle types. You'll hear me all the time speak about price, time. Those are the things that are consistent. It doesn't matter what instrument you're trading. There's always an hour. There's always a weekly candle. There's always a monthly candle, unless it's like a new stock or whatever the situation may be. Bullish candles, the market starts off low and goes up, then it means the momentum of the market is going up. And then the opposite for that is bearish candles. The price starts opening high, and then the price is going down. So the market is declining at that point in time. So price is declining. As you can see, I got this basic snapshot of this candle. Is tradingism.com. You can find it on the internet anywhere, but it's just basically showing the body of the candles. You can get that anywhere. What I'm here to do is like explain what that is. Okay. Let's move on down to tweezer bottoms and tweezer tops. All right. So with the tweezer pattern, you have, as you can see here, a bullish reversal pattern, right? So you have a that's tweezer bottom. So pretty much tweezers are candles, exactly what you saw. They have wicks, but there's a change in momentum, right? It's basically what we see on what you'll hear me say in the future called breaker structures, where momentum is going one way. And tweezer bottoms, you have the bearish candle followed by a small bullish candle, and they have nice size bodies and nice size wicks on them. And the momentum of the market has changed. It moved from bearish to bullish. And it says right here, a bullish reversal pattern formed by two or more candlesticks, right? With the same low followed by a bullish candlestick. So same low, right? So as a bearish opens high and then goes low, and then it makes a little wick on the bottom, then it closes, right? That next bullish candle, it starts at that same low, right? Let's say it'll come down, price will go down, and then it'll go all the way up, and then it'll close at the top, right? But they both have the same low. So it's a bearish candle to a bullish, and that's a tweezer bottom. And then just the opposite of that, the tweezer top, you have a bullish candle, and then they have the same the same close is the opening of the next candle, right? And then it's a bearish candle, and it shows the momentum of the market changing from bullish to bearish, right? So a bearish reversal pattern formed by two or more candlesticks with the same high, right? So as you see, tweezer tops was a bearish candle followed by a bullish candle, where price here opened and it had its high and its close low, and then the price moved all the way down here, and then followed by the opening of a bullish candle, and it went all the way high, and then it closed right here, but the two wicks on the top have the same high. So that's where you get your tweezer tops and your tweezer bottoms, because for the tweezer bottoms, the lows, their price was at went to the same spot, so you have them side by side, and price went to the same spot and rejected for some reason. At this point on the low, the tweezer bottoms, the low found support somewhere, and on the highs it got rejected for some reason. So for the tweezer bottoms, they both have support showing somewhere, and you'll see the wicks like side by side. They'll have the low is the same as the previous candle, and then on your tweezer tops, the high is the same price on both candles. This low of the bearish candle was, and then it shoots straight past the bearish high candle and creates an engulfing candle at that point. The one on the right is larger in the overall wicks, and the body is larger than the one on the left. That's what engulfing means. The one on the right, I'll say it again, the one on the right is larger than the one on the left. And that's the high price and the lowest price and within the body. The body and everything. Again, your wicks can be super small. At the same time, the candle itself is the price is higher and lower than the previous candle. So in the bullish engulfing is coming off of a bearish. So our bearish engulfing is the opposite of the bullish engulfing, whereas the bullish candlestick is smaller than the bearish candlestick on its right. With that being said, again, the lower low is lower than the previous candle, and the highest price is higher than the previous candle. That's why it's engulfing. That's why it's a bearish engulfing, because the bullish candle is smaller than the bearish candle. And again, this is left to right, so the left candle is smaller than the one on the right. No, and that's the total candle, right? It's the total candle. So Harami candles. You got your bullish Harami and bearish Harami. And pretty much you'll see me again. We're talking about bullish and bearish markets. Those are only two things in the market is bullish and bearish. You'll hear people talk about sideways, and all that means is that price is moving within a certain range. It's kind of fluctuating between that range. However, there's always a bullish and bear. If you go on a different time frame, you'll see a bullish momentum or bearish momentum of the market. So bullish Harami is just the flip of that, right? So we just did engulfing candles where the left is smaller than the candle on the right, and this is the complete opposite. So your left candle, the higher high and the lower low of that candle is larger than the one on the right. So the one on the right, you'll see, and this is kind of not, it's kind of throwing you off, but they can have the same closing and opening. So a bullish Harami, that's a bearish candle followed by a bullish candle. They can have the closing of the bearish and the opening of the bullish candle on the same level. However, the total size of that candle, from price being its lowest low and the highest high, has to fit within the previous candle. That's what a Harami is. So that means momentum, whether it be, in this case, it's bearish, and then it turns around, and then it's a bullish Harami, which means we're getting momentum in the opposite direction. However, it's not as strong as the previous candle where maybe price, like there was a lot of sellers and they were dumping their shares or their pips or their lots, depending on what you're trading. They were dumping them. You have a huge bearish candle, and then you have a small bullish candle where people start buying, but they're not buying at the same rate as in the previous hour. Again, we're going to stick with the hour time frame. So at 12 o'clock, a bunch of people sold, and they have a huge candle. And then 1 o'clock, you have some buyers coming in, right? So they start buying, but they didn't buy as much as the sellers did in the previous hour, right? So therefore, you have a bullish Harami. And the same thing with the bearish Harami, where you have a lot of buyers, and you get a nice big bullish candle, and then people start selling off, and they don't sell as quickly or as much in that next hour as in the previous hour where the bullish people were doing all their buying, right? So you see a little selling going off, then you end up with a bearish Harami at that point. Pretty much all of let's talk about the bearish Harami, all of the buyers in that time, they'll start selling off a little bit at a time because they've hit their price mark, right? They've hit their whatever they wanted to drive price to. They hit that, so you start seeing people sell off. You'll see them sell off. You'll end up with a bearish Harami where people start liquidating their positions, right? Multi-candle patterns. So for multi-candle patterns, what we initially were showing just like one candle compared to the next candle. Multi-candle patterns are usually three or more, right? So then you start seeing actual momentum in the market with these multi-candle patterns. Let's take a look. So a hammer candle. A hammer candle is like a bullish reversal pattern. So you'll have in this case a bunch of bearish candles on your left, and then you'll see a hammer candle show up. In this case, there's no wick on the top, but there's a long wick on the bottom, because when price opened, it went down and then came up. And at the top, when it closed without a wick. So then you end up with a hammer. That hammer shows that, hey, where sellers were in control before, you had a bunch of bearish candles, buyers are starting to come in and buy positions, right? They're starting to buy their positions. So you'll see the candle move up and then it'll close. And then as you can see here, you see a bunch of, on the right-hand side, you see a bunch of other bullish candles next to it, because the momentum of the market is starting to change. So recognize that when you see a hammer candle, recognize that buyers are starting to come into the market and they're positioning to drive price up. It doesn't always happen like that, because, again, just recognize the pattern of that candle, because sellers could come back in and like, nope, we're still selling off our positions, and there a couple buyers may have drove price up that hour, and then sellers come back in and finish liquidating, and then price can still continue down. However, just recognize that hammer pattern as such, and then your inverted hammer is just exactly the same thing. It's the complete opposite, right? So I just said, whereas you got a bunch of bearish candles going down, and then there were some buyers that came in and tried to drive price up, and sellers was like, nope, we're still liquidating our position, to the point where there's no wick on the bottom, and you have a nice little closing of a bearish candle without a wick. You have your inverted hammer. And again, your next candles could be bullish, or it could be bearish, right? But there's, again, it says also indicating a potential bullish reversal, right? Because right after all these sellers came in, buyers started coming in with an influx of buying positions, right? So you'll see the next hour, the next hour, the next hour, whereas price is just going up and up and up and up. So these are good indicator candles, and this is the reason why I brought these up, because these are good indicators of momentum changing candles, and that's pretty much what I focus on. Whereas positions that you're in, you're looking to like either liquidate or get into a position where you start buying or you start selling, these are good indicators of breaker structures where momentum is going to change. And if you look at it on a lower time frame or a higher time frame, you can be a little bit more active in changing your position. Okay, let's go to the next one. Shooting star patterns. So these are like, I say 3 candles, but the reality of the matter is they're more than 3 candles, all right? So you'll typically, as a morning star happens, you'll typically have a bunch of bearish candles, and then you'll have a nice short candle where momentum is going to change. You get, you'll have some nice large, like maybe it was a big engulfing bearish candle. Then you'll have some more nice large bearish candles, and then you'll get this small bearish candle, or maybe even a small bullish candle. And then you know that, hey, the sellers have stopped selling and the buyers are coming in, because whatever momentum it is starting to slow down. You'll get a nice little small one. And then that next following candle will be a bullish candle. It'll be a large bullish candle. You typically don't see it like a small one next to a small one. That's not really a morning star. But you'll see a nice large one where momentum is starting to go back the opposite direction, and the buyers are coming into the market and they're buying up whatever those people just sold, right? Because all of that selling with those large candles created a lot of imbalance. So there's a lot of buy orders that these companies are putting in place to drive price back up now at that point. And evening stars are just the opposite, right? So you get a bunch of buyers in, you get some nice large candles where the buyers are in, then you'll get either a bullish or bearish candle at the top, and it'll be smaller than the previous candles, like 2 or 3 candles will be smaller, and then you'll show a pattern reversal, right? Whereas the next candle is a nice large bearish candle, you'll see the actual momentum of that market changing. So you'll have like a couple hours where it's bullish, and you'll have a nice small candle for an hour where the market is consolidating and trying to figure out what it's going to do because the sellers are coming in. Then you'll see a nice a surge in selling going on. And these patterns are like very vital because a lot of times we get in a position where we're like, oh, price is going up, price is going up. Then you'll see a small little candle for the next hour. And you're like, I'm about to get in. You stop and look like, oh, that's kind of small. Sometimes it pays to wait. Sometimes, to see what the next candle is going to look like before you enter the market. So that's the reason why we're going over these patterns. And then we have our candle pattern. Remember I said like 3 or more. You'll start seeing like either a bullish, they call it 3 white soldiers. So the momentum is going up. There's a lot of buyers in the market. And then wherever there's buyers, there are sellers, right? So then you have your 3 black crows. And that's all the sellers coming in for the next 3 hours. All they're doing is selling off their position. So these are the basic candles, candle patterns. Let me do a little summary here. These are the basic These are the basic candle patterns, and the examples of patterns that are actually stocks and charts, and highlighting these patterns and subsequent price movements. This is where you'll start understanding the momentum and the movement of the market at a better rate, and when to enter and leave the market, because you'll start seeing the buyers coming in. Where if you have a selling position or a bearish position, then you'll start seeing sellers come in, and it may be time to exit the market at that point. Or if you might see, oh well, buyers are coming in, and it's not such a strong candle. You might leave your position open a little bit longer, but always protect your position, because we'll talk about that a little bit later. Understanding candlestick patterns is essential for successful trading and investing. Practicing, identifying, and analyzing these patterns to improve your decision making and market timing. We always talk about timing. Remember, I say price and timing, right? So we've only been talking on the hour, and let's get into taking a look at the some charts. Okay, so I'm going to take a look at Bitcoin. I don't trade Bitcoin personally, but at this point in time, this is the fad, and I don't want to really call it a fad. I don't really trade Bitcoin, but we're gonna take a look at Bitcoin because at this point, this is on the weekend. It's actually actively going on right now, and it's so volatile at this point. There's a lot of the candlesticks that we just talked about. So I'm going to highlight a couple here. Here's some tweezers here, right? We got our tweezer patterns. Here's the, let me see if I can find the opposite of it. So I'm gonna mark this other one, but this is an example of tweezer pattern the opposite way. But this is tweezer bottom and it's tweezer top. At the same time, this one here is a harami, where it's a bearish harami, where the bullish candle is larger than the bearish candle on the right. So, but pretty much as close to a tweezer pattern Um, you don't really get a lot of tweezer patterns where it's exactly the same size. So, but that's a good look at it. However, you're looking at uh, delete that, and if you notice, I'm on my hourly time frame, exactly what I've been talking about the whole time. So this means this the candle took 60 minutes to develop, right? So here we're looking at a nice bearish candle, and don't get caught up on the colors because you can make your chart look whatever color you want it to. For me, my bearish candles are white, my bullish candles are black. And I know we talked about white soldiers and black crows. That's the reason why a lot of times, like coming up with names for patterns, just stick to bearish and bullish candles, and you'll be fine. So let's look here. Here's a nice bearish candle. You see, you got a nice body right here, a nice long wick, and a nice long wick for low price. And you see prices traveled all the way down here. I'll put a couple marks on here. You see prices traveled from 28,877 all the way down to 27,835, right? I'm not going to do the point, whatever, but you get the point. Price travel within an hour. Let's take a look here. I'm going to bring my trusty crosshairs out. 104,035 points. It traveled that far in 1 hour. So that's over 100,000 points that it traveled. I say points because I'm looking at this is more of a forex base, and it's the same thing. If you look at price, in the market, in the stock market, you'll say, hey, price traveled 50 cents. It traveled $1. Every penny is a point, right? So if it's 100 points, it's $1, right? If it's 1,000 points, it's $10. It's the same thing. So I speak in points a lot of times, and that's so everything is measured across the board. It's the same. So here again, you see a nice bearish candle. Get you a nice wick up top, nice wick on the bottom. It has a nice body, right? And then here, if we take a look, delete this. This is where it comes in. You got to pay attention, right? So we had a nice bearish candle right here, and let's zoom in a little bit. Had a nice bearish candle here, price momentum, and we said it moved over 100,000 points. And then it opened here and kept. So we see we had a nice candle here to the left. It had a nice opening, nice low and high. It was like over 100,000 points. And then you see the next candle opens and then just goes straight down and develops this small little wick here. Now that's a hammer with the big mallet, right? Because you have the small wick on the bottom, but you have no wick at the top. So you end up with a hammer pattern. It doesn't look like most hammers because it has a big mallet on it, but it is a hammer by definition. It is a hammer. So with that being said, you're like, oh, that's a hammer pattern. So price, a lot of sellers were in the market. Price went down, and you see there was a couple buyers that came in at the bottom, and sure enough, price went down a little bit, and then the buyers came in. And then you get a couple little. You see, let me take off my period separators. There you go. So then you see over here, you see a couple of inverted hammers, right? So If I move this box here, and you'll see an inverted hammer. Pardon me. And you'll see a nice little inverted hammer right here. And you see, this is like kind of sort of a hammer. You have an inverted hammer followed by a hammer, right? And I apologize, I did not go over what they call dojis. Dojis are where price has gone up and down, and then it closes exactly where it opens. It looks a little like this, but it'll just be a line. It'll be actually this is a doji right. This is a doji. So price open, it went up, it went down, and it closed right here. It closed exactly where it opened. So you see a nice little dash. That is a doji. Price opens and closes in that hour exactly where it started, right? That way, you know, it's what we call price is still deciding where it's going, right? It's consolidated. So there's no buyers. Buyers aren't in control in that hour, and sellers aren't in control that hour. So price open and close where it started. So there's like typically nobody in control. And understand these wicks can get super long. You know, there could be a bunch of buyers coming in, driving the price up, and a bunch of sellers coming in, driving the price down. The buyers come back in, and then it closes where it opened. It just happens like that. And for that hour, that's what happens. And see, in this case, it looks like there were some sellers, and then a bunch of buyers came in, and a bunch of people sold. And I could, so this is what we talk about where you start looking in on a different time frame. So let me do this here. So let's take a quick look at this doji. I'm on the hour. Let's go ahead and mark this doji right here. And let's take a look at what it looks like on the 30-minute. And on the 30-minute, these two candles here, you see again, what is the white candle right now? This is our bullish candle. Excuse me, this is our bearish candle. So price opened here and it closed here. And within that hour, it opened here and it closed here and went right back to the same price that it opened. That's how you get to see in real time what a doji is. A price will open and close at a certain time frame, and then it will reverse its pattern within that same time frame. So if it's 30 minutes, it'll be 30 minute and 30 minute. You'll get a doji hour. If it's so you get a doji hour. A 4 hour, you'll get 2 hour candles that, you know, have price movement within a higher and low, and then you'll have 2 hour candles, or sometimes it might be an hour. However, in whatever 4 hours, price will have gone back to where it started. In 4 hours, you know, it may have started in one place, and then within 4 hours, it's right back to that place. If it's a 5-minute candle, that means in the first minute it started out here, but within the end of the 5 minutes, its price is back where it started. So again, if it's so that's what a doji is. Let's take a look at a couple more here. I don't think there's too many morning stars or anything like that, or evening stars. This would be what we call like the three white soldiers, but they're black on here. And let's see. Let me go back to the hour. So now I have to move this. So this is an example of there's a lot of buyers in the market. Then remember I said those smaller bodies, and you get a lot of movement. They're typically price consolidating, right? You have a lot of buyers going in, and you see buyers moving price up. but price is coming right back down to where it's open and closing within like only a short span of points. So let's take a look at a couple of engulfing candles. So here's, I will say that this, let me move this box over here. This is probably, I'll see if I can find another one, but this is probably an example of an engulfing candle. So this is another example of how markets change. So you get you a nice size bearish candle, price moved in an hour, you know, let me look here. Somewhere about 20,000 points. And no, you're like 20,000 points. Trust me, once we get into other things, I'll tell you about position and trade size. All of that matters is that you understand in your instrument that you're trading how quickly price can move within an hour, 2 hours, 1 minute, 10 minutes, a day. That's when that comes into effect of how much you risk. So that's why these candlesticks are so important. You're looking at candlestick size. You're like, oh, okay, in an hour that was 20. That was 20. Now look at this next hour where we have an engulfing bullish candle where price moved 80,000, which is 4 times what the previous candle moved. Let me double check that. Was that 80 or 800? Oh, wow. So what you see is the following candle that engulfed the previous candle moved 80,000. The previous candle only moved 20,000. You'll see that. So what you see here, it looks like it's the same low. So we're just going to call it engulfing. But typically this wick will be lower than the bearish candle. The bullish candle will have a lower low than the previous candle and a higher high than the previous candle, and it will engulf the previous candle. Let's take a look at the flip of that, where we'll get a bullish engulfing candle. Zoom out a little bit, see if I can catch one. I don't see too many. That's funny. I don't see too many bullish engulfing candles. That's textbook bullish engulfing candles. I would say if I zoom in right here, this is probably the best we're going to get as far as a bullish. Oh, where did it go? Oh. Let me take a look. I don't really. Oh, here's a nice bullish engulfing candle. I didn't see too many, but here's one right up. You know what I'm gonna do? I'm just gonna delete this. I'm gonna move this box right here so you can just see. Right here, this is a perfect example of an engulfing candle, uh, where you see the previous bearish candle, the lower low, and the higher high is on the left, and then on the right is your bullish candle where the lower low is lower than the previous hour and the higher high is higher than the previous candle. And you see this is textbook here with a bullish engulfing candle. Perfect textbook example. Yeah, I don't really see too many. I see nice haramis showing up for, nope, because that's below here. However, so the whole intent and purposes of being able to identify this is understanding the momentum of the market. Here you see bearish momentum, then you'll see bullish takeoff, and you see because of this imbalance, there are bearish candles, and you get a little fluctuation hour to hour, but then it eventually comes and takes over and ends up clearing up all of this imbalance eventually. This is like hours and hours later. So understanding the market, like, hey, I got this big push up, and then I got a nice little harami right here. And it's like, okay, I think momentum is about to change. And then you see for the next couple hours, it changes, but then it goes back up again. So you just got to be aware overall in the market where you are on an hourly basis. We're looking at hour. as opposed to a 30-minute, 15-minute daily. Understanding where that hour is in the momentum of the whole market. Looking at these candles, you'll be able to understand if the market is changing, if the momentum is changing, if it's going from bullish to bearish, or is it just part of the fluctuation of the market. In this case, you see it went down, it came back up, it did not, create a higher high, and then it kept going down. So if I go back out, and look at a 4 hour, it'll just show me like, hey, um, the market is like going down. So you see it right here. So here's the 4 hour candle here on your right. Let me see if I can zoom in a little bit so you can see it. Here's that 4 hour candle. And you see it went down and it came back up, right? A couple hours later, and it kept going back down after that. It didn't create a new higher high. And as you get used to looking at candles, you'll understand within a certain time, the price has moved up and down. And if the momentum is up for a period of time and then continues down, then you'll understand it. Here you see, let's draw a quick line. Price went up, came down a little bit, back up again, only to do what? Continue down. So this is the cheat sheet for candlesticks 101. These are very vital and important. I hope you learned a lot from this. I hope I gave you guys some good value added stuff. Again, I'm C3 with the Investment Process Channel. Thank you for joining. If this content was great, go ahead and hit that thumbs up button and subscribe to the channel. And please share it. Send it to somebody else will that can benefit from this. Thanks again.